Good afternoon to everyone and welcome to the Brighteye Edtech Startup Festival 2023 and the final session, no less. So far this week, we've hosted 5 sessions focused on product, impact, people, marketing, and exits. Watch out for the recordings for all of them apart from the exits one. And now this afternoon, we're diving into finance. Just a quick intro to Brighteye, unless you've been on events earlier this week. Brighteye is an early-stage edtech fund investing in seed and Series A across Europe. We announced the closing of our Fund 2 at 100 million euros earlier this summer, and we are, of course, always looking to connect with you founders and edtech teams out there. My name is Hege, and I am Head of Community at Brighteye, working on our portfolio support, communications, and events, like this festival. Thanks all for joining us for this session on finance, which has a twist in the format, changing from panel conversations to a masterclass on the important finance basics to keep in mind at the early stages of building your edtech startup. I'm very, very happy to introduce Mattheus, our head of finance here at Brighteye, who will talk us through. Welcome, Mattheus, and enjoy, everyone.
Hey, welcome all. Happy to be here talking to all of you on this topic that is finance for startups. And this month I'll be celebrating 11 years working in finance, so it's a good moment to do something like this. And well, so I'll share my screen, and the idea here is that I'll be talking about some of the topics that I think that are the most important for early stage companies. And feel free to share your questions on the chat, and I'll try to go through all of them by the end of the presentation. And if I miss some of those, please reach out to me on LinkedIn, and hopefully I'll be able to answer everything. And well, just as an intro, I'm Mattheus, born and raised in Rio, Brazil. And as I mentioned, been working in finance for the past 11 years. Started my career at EY as an external auditor, auditing companies in the financial industry for 5 years. Then spent almost 3 years working at Fitch Ratings in the accounting side of things. It was also nice because that's where I was starting to work in a SOX environment, which will be connected to the internal controls part of this talk. After that experience, I moved to Madrid, joined BNP Paribas, and then moved to Student Finance, a fintech that when I joined the company, it was post the seed round, worked there until we got the Series A, debt funding, and the FC authorization. And recently, almost 4 months ago, I joined Brighteye team. And here in Brighteye, I'm part of the platform team together with Hege, our head of community, as she already introduced herself, also Riz, our head of research, and James, our designer in residence. And we, from the platform team, we try to support all the companies in our portfolios, well, in every way we can. Besides the 4 of us, we also have 10 team of mentors and advisors to help them. And more. One of the things that I hear the most on early stage companies is about in-house finance function. And the first question is, when should we bring people in? And as you can imagine, it depends, right? Depends on the stage of the company, depend on what the company does, the level of complexity in the finance department. If you're a fintech, for example, it makes sense to have someone from finance since the beginning. But if you're not, then it's going to depend. Usually companies tend to get someone in between Series A and Series B, but it's not a rule, right? It's all going to depend. And well, starting with outsourcing. Usually companies outsource the accounting function, tax, and payroll. And those make sense because founders got to create a company, make sure that everything's working, products being developed, it's growing, getting some traction. And those are functions that are quite time consuming. They depend on regulations. They change from country to country, and makes sense to have these functions outsourced. And I mean, even when you have your first finance hire, it still makes sense to outsource most of them. Because when you're outsourcing these services to a bigger company, a specialized company in the topic, people are going to have the knowledge. They're going to be up to date with all the news and changes in regulations. And that's where you don't want to make any mistakes, right? When you have to do your filings, not only for your annual accounts, but also tax-related filings, payroll calculations, like all the taxes, pension. I mean, it doesn't really worth the risk of not getting those properly done. And well, one of the things that people have been outsourcing recently is the CFO role. And it could be quite helpful because, again, by outsourcing it, you have full support of a bigger company behind them, and it's not only one person. What can be a bit tricky is, as you're not their only client, you gotta share the time with other people, and well, it's a service provider, right? So we all know it can be good, it can be bad, and well, it's something that companies gotta try and see the ones that are gonna be working for them or not. And well, on the topic of the CFO being outsourced or not, also we have fractional and interim roles. Think about the fractional as someone working part-time, whilst the interim would be working for a determined period of time. Usually we see interim roles to cover for leaves, but also they can be used in specific moments of the company, right? For example, when you're about to fundraise, you could have someone in the interim position preparing all the finance-related topics and working with you until you get the fundraise, then create all the processes necessary to make the finance function work well, and then leave the company until you get to a stage where you need someone in-house to do so. And on that, there's also the tools, as you can see here in the presentation. Nowadays, lots of the tools can do pretty much 90% of the work for you. If you think about Xero, QuickBooks, you can have everything there. It's going to help you a lot, but it does need some kind of knowledge on finance, accounting, tax. So if you're working, for example, with the fractional position, would more likely than not need a good set of tools to be assisting them. Or the interim role, this person will also need to implement those tools so things will be able to run on their own after they leave. And again, there's no right or wrong here, which one you should hire for your company or when, but it's also good to seek professional advice before making any of those decisions. And well, coming out to a point that I think it's extremely important, but people not often pay as much attention as they should, is to create a good internal control framework. And when we're talking about internal controls, we're not only talking about accounting, but we're also going through like procurement, like how people are getting approved to, travel and expenses, getting a new tool on their tech stack. It's easy to lose track of things, especially when the company is growing, and even more right after fundraising round, right? Because some companies tend to think that once they were successful in fundraising, they can start spending money without any control, and that can be particularly tricky. And on this topic, I also think that it's important to get things done, properly documented, create a process in the early stage, rather than having a backlog and having to deal with it in the future. And once you don't have control on that, your tech stack's going to grow a lot. People, for example, people want to have ownership or accountability for the tools that they sign. And it's not that uncommon to see tools that are not being used, but money is being spent on that, which doesn't make sense. So it is quite important to do it properly in the beginning. And if you want to do it in the most efficient way, you also would go with the tool that already exists in the market, or you can create your own internal process. The problem with creating your own internal process is that you need to be revisiting it all the time. You got a document, I don't know, maybe Notion or Google Docs, whatever, but this has to be updated, right? And it's a problem when you create something that you don't get back to it, you don't use it, people forget that it exists, and in the end, it's useless. So you don't want to get there. And that's why using some tool is going to be quite helpful. For example, Spendesk is one where you can create this limit for approvals, and all the management, invoices, everything is controlled there. So, well, there are others, but something on this sense be quite helpful for companies. And well, reconciliations are quite important, especially when you don't have a finance person in-house. And this reconciliation, they start from basics. Bank reconciliations. In the month end, you check if what's booked on your accounts matches your bank statement balance. But it also can go a bit more complex than that. You can check your revenue, everything that you invoiced with your billings, things like this. And this is quite key for you to be on top of everything that's going on your company. This can be particularly tricky when the accounting function is outsourced and there's no month-end closing, rather only a quarter-end or year-end. But it's important to keep track on that. I would start bank reconciliation has to be the first one, and then you would go to then billings, revenue, and you could go also to payroll, keeping in mind that everything has to be timed, everything has to be documented. And one of the ways that I try to simplify the reconciliation part of things, that actually the data quality and completeness, is pretty much every entry that you have on your bank statement needs to have an underlying documentation supporting it. So you cannot have money coming in or coming out from your bank accounts if you don't have a document supporting it, right? And it's particularly important to have it on max on a monthly basis to avoid piling up things. And then when you get to the end of the year, actually after the end of the year, that you need to do your tax filings, for example, your external accountant is going to ask you for invoices since January, and you have pretty much no idea where they are, and this can be a problem. It's going to be a headache for sure. So this is usually forgotten or ignored, but it's quite important to keep track on that. Well, I'd say that both of the topics that I mentioned before, all together, they combine in having a well-established and perfectly functioning FP&A process. And when you think about FP&A, we should start segregating stuff between management accounting and financial accounting. Management accounting, you can think about it as performance, as targets, KPIs, things that you gotta report to your stakeholders, like your investors, management. Whilst financial accounting is the more related to the bookkeeping part of things, accounting, entries, journal entries, findings, etc. and financial statements also on the financial accounting side of things. And this is particularly important to have a distinction. For example, metrics that are very well discussed today, like ARR, those sit within the management accounting, whilst revenue, like your income tax, your total assets, intangible assets, those sit on the financial accounting. And here it's also quite important to make a distinction. So revenue does not necessarily mean that is a cash inflow. And I've seen lots of companies trying to simplify their financial model, attaching growth in revenue with straightforward growth in the bank balance. But important to segregate things. Billings and revenue, one thing. Also, you can have accruals for that, and cash is more related to the cash collection side of things. And those are very important to be distinguished as well. And it gets me to budget forecasting and actuals. When companies are fundraising, they usually create a deck, they create a financial model where they are projecting their trajectory for 3, 5, 10 years to present to investors. And it's key for those companies to keep a track on how accurate those forecasts were, and if anything has to be done to make actuals be the closest to the budget and forecast as possible. Usually what can happen in this kind of situation is that companies overstated or were too optimistic on their growth of the revenue, the growth of their cash collection, and they underestimate the costs, right? Because the net there is either the cash that you're generating at month end, that's gonna grow your runway, I'll get to that soon, and at the same time, this is what increases your revenue, decreases your expenses, and makes you profitable. So my suggestion here is, after you've succeeded with the fundraising, your company is operating in a normal basis, you use the same model that you presented to investors and you duplicate it. So then you would have what's your budget, what's your actual, and start comparing those. Also, there are several tools in the market to assist you to do that, but this is key to see. Let's say we're spending way more than we expected, and you need to understand why. Maybe it's because salaries were higher than what you imagined before. Or worst, when you were budgeting, you forgot to input the payroll costs on there, which is bad. But as soon as you realize that these things are not working out as planned, you have more time to try to fix it somehow. Also, if your revenue is not growing and your cash collection is not growing as expected, you can try new sales strategies. Or if the problem is that, okay, you're selling, but you're not collecting from your customers, you need to find a way to make the cash collection process easier or start to chase them. So it's super important to keep track of those. And I like to do it by duplicating what you had on your budget, and then you have your actuals, so you don't change your budgets, right? You can see the performance, what you expected, what's happening in reality, and then you can fine-tune everything. In the best case scenario, you're going to be above your targets, right? You're going to be making more revenue than you expected, collecting more cash than you expected, spending less money, which is great. This is going to extend your planned runway. So, I mean, the idea here is to keep track on that. If you can do it on a weekly basis, perfect, but it's unrealistic, but at least on a monthly basis, it's important to do so. And this is where you're going to have your reports, your investors updates are going to come from there. Your even internal ones also going to come from there. And this is key to support the decision-making process in a company, right? Let's say if you realize, again, that you're spending more than you expected with payroll, not generating enough cash, you need to, unfortunately, do some layoffs. Or this is also the moment where you see that, okay, the number of tools that I subscribe to, my tech stack's way higher than what I expected. Let's see in the details where I'm spending money, if things are being used or not, and then you can cut some of these unnecessary costs. But this is the kind of thing that you only know if you have this kind of process in place. And the idea behind doing it on a monthly basis is to be top and be able to change directions as soon as you realize something's not working out well. And this gets me to Runway. Runway, in my opinion, is one of the most important metrics for a startup. And when in a fundraising process, usually people say, I need that much money to reach my milestones in this period of time. Let's say I need 2 million to get to 2 million of ARR in 18 months. And that's the plan on how I'm going to spend this money, how I'm going to invest in people, how I'm going to develop my product, how I'm going to go to market and get clients to reach this milestone. And this time frame is what you need to have in mind, that this money is going to exist for this period of time. And there's a problem with financial metrics is that when you go to accounting is always looking to the past. If you have the best accounting process in the world, you're at least looking to yesterday, but accounting do not tend to look forward. Okay, you can argue that on your accounts receivable, on your accounts payable, it's money coming in or out of the company in the future, but this is looking as of at least yesterday. So when you're looking for Runway, the formula that you can find online is usually your cash balance divided by the cash that you burned last month or the average that you burned in specific periods. And this is tricky and a problem. If you're growing a company, you're hiring people, meaning next month, your burn is going to be higher than last month. Okay, you can increase revenues and the cash or the cash collection. This is going to potentially decrease your burn, therefore extend your runway. But just by looking to the past, you won't be able to have a good idea for how long your company can still exist. And that also connects to the importance of having a very good FP&A process. Once you start populating, after you duplicate your budget, start uploading it, updating it with your actuals, you can see those metrics changing on a live basis, meaning, okay, I expected to have 100 monies coming in. I had 90. This means that my runway is going to be shortened. So that's super important. And try to avoid just looking at metrics that you can see online, because these can be a big mistake. And you don't want to be surprised by that. So the way that I rather calculate runway is by updating my budget versus actual and forecast analysis. And well, there are ways of how a company can extend their runway, at least a little bit. And there are besides getting another funding round. Companies can go and have credit line with banks. Ideally, you wouldn't need to get those to access those, but this is something that can guarantee that your company is going to survive at least until you reach your milestones or the next fundraising moment. And of course, depending on the level of your necessities, you should talk to your investors before making those huge decisions. But credit lines is usually an important thing to do. Renegotiating your terms with your suppliers. If you have a problem in collecting payables from your customers, you can factor it. Also not good because you have a discount. All of those things to extend the runway cost money. So ideally you won't need those, but it might be necessary. And well, I recently published it on Brighteye's website, a piece on Runway, and you can check there to see how a bit more in details what is written there. And well, that would be pretty much it. Open now to your questions. I'm not sure if there's anything coming from the audience, but I'd be happy to answer those or get back to any of the topics that I mentioned before. Getting to Chris' question on Runway being different as cash flow forecast, I don't think they're materially different. And the idea here is that Runway is particularly, I don't like this metric. I think that it gives a wrong idea on how the company is doing. Actually, not on how the company is doing. This is quite accurate, but it doesn't factor in the expected expenditures for upcoming months. So in my opinion, I would always use the cash flow forecast rather than Runway. Runway only works if you have a constant, right? If you say that you have a runway of 12 months today, this will mean that your cash will only end in December 2024 if nothing changes. But in a startup, if nothing changes in 1 year, something very wrong is happening. So I would always go to the cash flow forecast. And on forecasting cash flow, what we usually recommend companies to do is to create different scenarios, right? The first scenario, what you expect to have based on your actuals and your original planning. Another scenario where your revenues, your cash inflow is decreased in half. And then a third scenario where you have maybe even lower cash inflow and also doing some cuts on your cash outflow. So you can think, okay, if everything goes well, we're going to survive for 12 months. If things start to going a bit worse than expected, you will, like worst case scenario, we get to 6 months. And somewhere in between, we're maybe in 8 months or 10 months. So this is quite important to keep on top and to be also fair with your stakeholders, not only your investors, but also your employees as well. And well, getting here to Yusuf's, hope I was able to answer your question, Chris. And then getting to Yusuf's question on in the current context, the expectations between growth and profitability. Again, it all depends on the stage where the company is, but profitability tends to happen in a later stage, where it means that your short way of saying your income is higher than your expenses. And this might need like several years to happen, or in the past there were companies that had an IPO and weren't even profitable, and this is tricky. But growth is more on the number of clients that you're getting. You're increasing your revenues. Usually an increase in revenues comes all together with an increase in expenses. Let's say sales team. If you want to expand internationally, start selling your product in another country, you need to find specialized people to sell it in this other country. So this comes all together, which may make your company not profitable, but you're going to be growing your number of customers, your users, traction, and it would go a bit like this. So yeah, hope this clarifies your question, Yusuf. And then I have another one here from Levi. Sorry if I'm saying any of those names wrong. At what stage, in terms of revenue financing stage, does it make sense to carve out a dedicated CFO role for startups? Again, this is a tricky one. If you Google it, people are going to say between Series A and Series B. It depends. If you're a fintech, you should have done it already. If you're not a fintech, you might take a bit longer to do so. And it also depends on what are your needs and the profiles that you have available to fill this role. Sometimes the person in the CFO role can be very good in operational terms, or the other way around, and you wouldn't need someone to do this more for the basic finance functions. But a CFO has to be seen not as a bookkeeper, not an accountant, but a key member of the team. It's going to be the person that's going to be analyzing the KPIs and usually has somehow a critical view of things, and that's able to change directions on what's going on and try to make things better. So also, the CFO has a key role in fundraising processes, not only on dealing with investors, on the investors relation part of things, but also on the due diligence process, as it's going to be probably the main point of contact with whoever's conducting the due diligence on the finance admin part of things. And well, my personal opinion on that is that you cannot find a CFO right when you're trying to do this fundraising process. You need someone that will get familiarized with the company, someone that will understand the market, especially if someone that's a first-time CFO or wasn't in the startup world, someone that was working in public companies will have a different view. I mean, we'll get to a startup and won't understand lots of the things that are happening, and that they will need to adapt and learn. And I'd say that if you're thinking about fundraising process and you're already after Series A, you should have a CFO. Then you need to analyze if it makes sense to have someone on board full-time, or if it's a fractional CFO makes sense to you. And then it kind of depends on some case-by-case basis. Tough to try to put everything in a bucket. Yeah, Yusuf, I've seen here your question on the 40% rule, a trendy KPI is the 40% rule. I think that in the past few years, we tried to put all companies in a bucket, especially SaaS companies, and compare SaaS companies as a whole. And what happens is that products are different, And even if you sell to the same kind of customer, if it's a B2B or a B2C, you cannot put everything on the same bucket to analyze like gross margins, like that your gross margin has to be 40%. It can make sense in some products, it's not necessarily going to make sense in others. And I tend to be quite skeptical on this kind of topic. I find it tricky to like benchmarks, especially with an auditor background. Benchmarks is something that scares me a bit because you don't really know where this information is coming from. This information is usually not publicly available or not externally validated by auditors, for example. So I try to be quite cautious there. And my take on that is if you're talking to investors and you know your product compared to the benchmark of the industry that you are, and if you're not aligned with the benchmark, you need to have an explanation for that, right? Maybe your product is more complex. That's why your costs attached to it are also higher, which can lead to tougher times on growing it, but gotta be honest with you and also honest with your investors and be able to explain it. I think that would be key on that. Well, I think there are no new questions here, or yeah, hope that was a good answer, Yusuf, and happy to talk about it outside if you want. Well, that was it. Feel free to reach out to me if you have any other question on finance in early stage companies, and I'll be happy to go through them with you. Thank you.
Thank you so much, Mattheus. That's absolutely excellent. And I would definitely recommend checking out that blog. I left a link to it in the chat. And just like that, the Brighteye Edtech Startup Festival is over for this year. Thanks a lot for joining this week. Most of the content will live on. We'll share recordings and write-ups in the coming days and weeks. So make sure you follow us on LinkedIn and X for those and for any other updates. Hopefully we'll also see many of you at other events, our own and beyond. And I wouldn't be surprised if you saw us returning with a brand new Brighteye Edtech Startup Festival in 2024.